It's a new tax year and a new ISA allowance allows us to add to our portfolio or start new ones. In this video, I look at adding to my new ISA portfolio that I started with Interactive Investor last week, and I'll show you why I think these shares are worth a buy. I'm Anthony, and as always, we're talking money. Okay, in my last video, where I went through opening a new ISA account, I said that I use Stockopedia to sift through the whole stock market using my investing criteria to whittle 2,000 stocks down to just a handful. Incidentally, I was asked by one subscriber why I stick to just UK shares. It's a great question, to be honest, because there's actually nothing to stop you or me investing in shares anywhere around the world. But essentially, I stick to the UK for my ISAs because when I compare one share with another, I know that all the accounting standards are the same. I'm comparing like with like. American accounts, Indian accounts, Australian accounts all follow slightly different rules. But the main reason is that if I trade shares in another country, I'm introducing an additional currency exchange risk, which makes the whole business much more complex. And although I did economics at university, one thing I did learn is that economics is a lousy predictor of the future, and that includes trying to predict what's going to happen to currency exchange values. So anyway, back to choosing the shares for this new portfolio. My criteria are covered in some depth in my video called How I Choose My Shares, so I won't go over all that again for you, but I will put a link on the screen, I think on this corner up here, for you if you haven't seen that already. But essentially, I sift the market using a valuation criteria, namely the price earnings growth risk ratio, coupled with an efficiency ratio in the form of the return on capital employed ratio, and finally using Stockopedia's own stock rank that simplifies fundamentals like cash flow ratios, momentum, debt, all those kind of things. So from the whole market, it's now reduced to just 14 shares now. Not bad from 2,000, but I hope they're good ones. Anyway, I'm looking to start this portfolio with about 10 shares if I can in a variety of different market sectors. And here's the list that the sift came up with. There is one here that I might discount straight away, and that's CAS Minerals. Nothing wrong with the company at all, but it is subject to a takeover bid and it's had 3 offers already, and the directors are probably going to accept the latest offer that's very close to the current share price. So although they may get a further offer, I think I'll personally leave that one alone, as the price has advanced so much on this takeover bid that was announced some time ago. By the way, takeover bids of companies from this sift are not uncommon. After all, what makes them attractive to me are the same reasons why they're attractive to a competitor, and takeover bids tend to send the price northwards, which is always a good thing. This leaves 13 to have a look at more seriously. 6 of the 14 are in the basic material sector, and again, this is not that surprising. I have long been an advocate of miners like Sylvania Platinum, Rio Tinto, because as the economy emerges from the pandemic, demand will continue to pick up, but supply will lag behind as it takes time to get new mines to come on stream. In addition, the conversion to green technology puts an increased demand on basic materials like copper, platinum, iron ore and lithium, just to name a few. All these miners have come off their recent highs, and I think it could be a good time to add them to my new ISA. The only thing is I already have Step Cement, Rio and Sylvania in other portfolios, but we'll take a view at the end of the process. The next are industrials. They include a wide variety of companies, including ports like the one here, Global Port Investments. This particular company looks good on fundamentals, and I like the fact that they've got rising sales, a rising balance sheet cash figure, falling net debt and the payment of a dividend. The same can't be said about INCE Group, INCE Group, the next stock on the list. Although they're showing increased sales and profits, cash, net debt and working capital are not heading in the right direction. The shares have advanced strongly recently. They may have overshot a little bit maybe. That said, they are operating in a niche that should benefit from the effects of the pandemic, namely insolvency, litigation and dispute resolution, divorce and relationship breakdown. Put this one down as a maybe. SureServe, the next one, operates in the property sector, but not in construction, but in servicing houses, local authority buildings, etc., and advises on gas, fire and electrics. Not a bad sector to be in operating at the moment, and profits are rising year on year. The PE ratio of just 12 and growth of earnings of 20% gives a very reassuring PEG ratio, PEG ratio of just 0.6. Nothing too alarming in the cash, debt and cash flow front either on the balance sheet. Now, Morgan Sindall I own already in another portfolio, But that shouldn't be a reason not to have another look at adding more. This has been one of my super stocks in the past and has done very well. But are there some clouds in the accounts to give alarm? Sales and profits are all advancing to give a very satisfying PE, PEG and growth ratios. What I do like is that the cash on the balance sheet is going up, net debt is going down and working capital is going up. Really a winning combination. Shares are up 75% though since September, just 6 months ago. They may consolidate, but they do pay a pretty secure 3.5% dividend to keep me interested. Next comes the consumer cyclicals. Now these shares are ones that typically do well when the economy picks up. Strangely, something that doesn't happen to every type of business. You'd think that all shares do better when the economy lifts, but stocks that operate in, say, consumer staples, telecoms, healthcare, care homes are good examples of stocks that are non-cyclicals, often called bond proxies. Anyway, consumer cyclicals like SCS, the sofa sellers, and Character Group, that are the toy sellers, are great examples of stocks that should do well as the economy takes off. SCS has not had a good 2020, but what retailer has? But this one seems to show better fundamentals to me than Character. Character's accounts just look a bit wacky to me, and they may need further investigation. A yield of 13% rings alarm bells, falling operating margins, falling return on capital employed, and also falling cash now on the balance sheet are perhaps too many things to raise eyebrows. The next two on my list are Record, which is a financial company operating in foreign exchange management and currency hedging. Again, I own this stock already and it's done very well, but looking at the accounts, rising sales, profits is offsetting the slight bumpiness in operating margin and cash. Return on capital employed remains a healthy 27%, although this has been a little bit higher in the past. Finally, ULS is a technology company that deals in legal software. These types of companies are hard to take a stance on based purely on fundamentals. Tech companies are really priced as growth shares and consequently command much higher PE ratios. ULS is not that high, but higher than the rest on this list here. What concerns me though is that operating margins and returns on capital have basically halved in 2020 compared to previous years. But then again, it concentrates on the conveyancing side of the legal sector, and the upturn in the housing market after the latest accounts lead to a much higher anticipated sales, earnings and margins in the 2022 accounts. Prices have shown this optimism recently, and cash and net debt are turning in the right direction too, so maybe worth a punt after all. So after all that, what do we actually end up with? Well, after some consideration, I'm going to be buying these ones. Central Asian Metals, Rio Tinto, Evraz, Global Ports, SCS, Sylvania Platinum and Record. That's 7 to start with. I'm going to put about £2,000 in each share, leaving £6,000 in cash for some future purchases if they do arise, or if I change my mind on the ones which I've so far rejected. I'm aware that having cash not earning is the best way to lose money to inflation, but hopefully more opportunities will come our way, and if they do, I'll let you know. 7 shares is on its own not enough to give us a proper diversified portfolio. I'm well aware of that, but we have to start somewhere. Anyway, put in the comments what you think, and if there's some investing ideas that you want to share, check out my video that details my investing criteria. I'm Anthony, and as always, we're talking money. I'll catch you in the next video, but until then, bye for now.